I thought about calling this video The World According to GAAP, but I didn't think a lot of people would get that. If you get it, please comment and let me know I'm not alone in this. So what if every accountant made up their own rules? What if every company reported financial information in whatever way the employees felt like doing it that day? What would happen? Chaos, that's what. Confusion, deception. In this video, we'll be talking about GAAP and how it helps businesses, investors, and accountants all play by the same rules. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my always GAAP-compliant sidekick, Terrence. And we're here to put the fun in accounting fundamentals. But first, some history. Now, some of this history may seem oddly familiar, but travel back with me in time to 1929. The world, including the United States, had just gone through the devastation of a world war and a pandemic. Millions and millions of people worldwide died because of those two events. And after all that heartbreak, Americans were ready to party. But not with alcohol, since that was prohibited by the 18th Amendment. I'm kidding. Black market alcohol was readily available. Well, with all that dancing and drinking and partying, people still found time for their other hobby, investing in the stock market. And all that investing activity led to lots of speculation and, of course, fraud. And it all culminated in panic as the stock market started to drop. And October 29th, 1929, a day known as Black Tuesday, stock prices completely collapsed. Billions of dollars were lost, and investors were wiped out. And this crash, along with other factors, plunged the U.S. into what we now know as the Great Depression. So what does all this have to do with GAAP? Well, it led the American Institute of Accountants to recommend to the New York Stock Exchange some rules, some principles of accounting that were generally accepted and would provide consistency on how financial information was reported. And then this led to various acts by Congress meant to restore public and investor confidence in the stock market, because no confidence leads to people not buying stock. And no stock buying means that corporations can't raise the capital they need to expand. And this impacts the number of jobs that are available, which impacts people's ability to buy more stuff, which limits the revenue of corporations, etc. So the whole role of GAAP is to provide assurance that financial information is giving a true picture of the financial health of a corporation. Now, GAAP applies to U.S. companies. There's also global standards called International Financial Reporting Standards that are meant to provide ruling principles for all businesses. The U.S. has not at this time adopted those standards, but GAAP and IFRS have many similarities and some differences. Now, GAAP is broken up into three different categories. It's broken up into assumptions, principles, and constraints. So under assumptions, the first assumption is that a business is separate from its owners. So what that means is that if a business earns revenue or has expenses, that is not the owner's revenue or expenses. It belongs to the company. So this is called the business entity assumption. And we keep track of each business entity separately, and personal expenses would not be included in a business's records. Second one is going concern. This assumes that a business is going to continue on into the future. This is important when it comes to things like depreciation, because we are depreciating assets based on the assumption that that business is going to be there in 5 years or 7 years. The third is the monetary unit. So it's assuming that we have a stable currency, and for the US, that currency is the US dollar. And fourth is the time period principle. So that tells us that economic activities can be divided into time periods like a month, a quarter, or a year. And this gives us the basis for that time that we're looking at for sets of transactions. So a month is a unit of time, and we're going to encapsulate that month's activities within that time period. And then we talk about principles. So GAAP principles, the historical cost principle is the first one. And this tells us that we are going to record assets and liabilities at the acquisition cost. So if we buy a truck, we're going to record it at the price that we paid for it, even if we got a smoking good deal on it. And if we take out a loan, we're going to record it as the full value of that loan. We're not going to use fair market value, although there have been some pushes towards using fair market value. At this point in time, we're still using historical cost principle. The next one is the revenue recognition principle. Revenue recognition principle says that revenue is recorded when it's earned, not when we receive the money for it. And if you've seen the cash versus accrual basis accounting video, which I'll link in the description, you know that cash basis, we record revenue when we receive the cash. So revenue recognition principle is talking specifically about accrual-based accounting. The next is the matching principle. And if you've watched any of my other videos, you know I come back to the matching principle a lot because it's really important. It is the basis, along with revenue recognition, of accrual accounting. So the matching principle says we want to take the expenses and match them to the related revenue. So if we buy merchandise, we want to match that purchase of merchandise to the revenue that we get for selling that merchandise. So the matching principle and the revenue recognition principle are the basis of accrual accounting. And then our fourth principle is full disclosure principle. And that says that we should be giving as much information as is necessary for a prudent person to make financial decisions, but not so much that it becomes extremely costly to gather that information. Like we wouldn't put serial numbers on every single nail in a 50-pound box of nails. That would be crazy. We'd be able to track each and every nail, but it would be just an insane amount of detail. So we want to balance that information. It needs to be everything that's really important, and the stuff that isn't so important, we don't really need to include. We can do things like make a disclosure note in our financial statements. For example, maybe there's a lawsuit that's been filed, but we have no idea what's going to happen with that lawsuit, but we do need to tell people that it has been filed, and we don't know what's going to happen. So that's a piece of information that we would disclose, but it's not necessarily going to show up in our balance sheet because there's no details or concrete information that we can put into our financial statements at this point in time. Now, we also have some constraints. The first one is the objectivity principle. So this says that financial statements should be based on objective evidence. So for example, we have invoices that add up to the amount of our revenue. So we've got something to back that up with. It's not just a number that we pulled out of the sky. We have bills and canceled checks that will match our expense numbers that we're reporting. So objectivity says we've got to have some actual evidence and some real stuff to back up our numbers. We can't just make them up. Then there is the materiality principle. The materiality principle says, is this item of significance for this business? So for example, if your bank reconciliation is off by a penny, this is not a material number. A penny is not a material number for pretty much any business. So if you make an adjustment rather than finding that penny for 1 cent, it's not a big deal. Rather than spending 40 hours of your bookkeeper's time trying to find that penny, we're just not going to give it a lot of attention. But if it's a $10 million difference in our bank reconciliation, that's material. And this can depend on the size of a business. If it's a $1,000 difference in inventory for a really large business, it's not material. But if it's $1,000 difference in inventory for a small retail store, that's material. So there's some judgment there that goes along with that. Then there's the consistency constraint, the consistency principle. We want to make sure that we are reporting things from month to month in the same way. So for example, we can't take our depreciation and every month just change it to be whatever we want it to be. We have to pick a method and stick with it. When we're talking about inventory, we're going to pick one inventory cost method and we're going to stick with it. So we're going to use FIFO this month and FIFO next month and FIFO the month after that. And it also tells us that we cannot switch from the accrual basis this month to the cash basis next month and then to the accrual basis again the month after that. Then there's the conservatism principle. If you have two choices, you want to choose the less favorable outcome. If we are looking at a situation where we say, should we recognize this expense this month or last month? The one that has the less favorable impact on profits is the one that we're going to choose. Now, I will say that this works out really well if you're deciding whether or not to eat a donut, right? The least favorable outcome would be that you eat the donut. I'll leave that with you. Now, the last constraint is the cost constraint. The benefits of reporting the financial information need to outweigh the cost of supplying it. So this goes back to that 1 cent difference in our checking account. Would it be more accurate for us to find that 1 cent? Absolutely. But would it be cost effective? It would not if you've got to pay somebody multiple hours in order to find it. And then there is one final rule. If by following any of these principles, it means that we would be misstating material information or providing misleading information, we don't follow GAAP. We depart from GAAP. And we disclose then why we did not comply with GAAP. And that would be a rare occurrence. So you can assume that you will be following generally accepted accounting principles, and then you won't go wrong. So until next time, stay balanced, my friends.